Welcome back to Investing Talk Podcast.
Today we're looking at Unusual Machines, a
Yeah.
company that's, well, it's undergoing one of the most aggressive and, frankly, fascinating transformations we've seen in the drone and defense tech space in a long time.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For a long time, Unusual Machines was known primarily as a component seller.
Right, the FPV goggles. The Fat Shark brand. That was their whole identity.
Exactly. They dominated that market for ultra-low latency video goggles. But the core story now, it's completely shifted. It's about rapid, strategic, vertical integration. They're not just selling parts anymore. They're trying to become an entire platform.
Okay, so let's unpack that. Because that shift from just making a component to building a whole platform, that's a huge leap, especially in a sector like defense. So what are the key pieces they've added recently? What makes this real?
Well, it's so crucial because the industry is demanding these fully integrated, secure systems now. If you're only selling one component, you're always fighting on price.
And your customer can just swap you out.
Right. But by creating a unified platform, think of it like Apple controlling the iPhone and iOS,
Yeah.
you lock in that customer. You capture value at every single stage.
It creates that sticky ecosystem.
That's the word. And they've made two really critical moves in 2025 that show this is the strategy. First, the acquisition of Rotor Lab.
And this wasn't just buying another company, right?
No, not at all. This established a dedicated engineering hub for their own proprietary motor design and prototyping. Motors are the heart of a drone. By controlling that core hardware, they control performance, they get better margins, and, critically, supply chain security.
Okay, so they lock down the hardware. That's a huge step. But so much of the value in this space eventually moves to the software, to the brains of the operation. Did they address that?
They did. And that's the second big move, the merger agreement with Aloft Technologies.
The drone software company.
Yep. This adds that crucial higher margin IP. We're talking flight control algorithms, operational software. When you combine your own motors with your own flight control software, you create a system that is genuinely unique. It's very, very hard for a competitor to replicate that.
So this all sounds great, but wait a minute. Acquiring a hardware engineering firm and a software company at the same time. That sounds ambitious. That's a lot to integrate all at once. Is there any sign they can actually pull this off without tripping over themselves?
That's a fantastic question, and it's a huge risk we'll get to later. But what makes this whole thing possible, what underpins it, is their balance sheet. We often see tech companies burning through cash, but this company's financials are, well, they're exceptional.
Like, this is where it gets really interesting for investors. Let's talk numbers.
The first number is zero, as in zero debt.
In this interest rate environment, that's incredible.
It gives them so much resilience. On top of that, they recently reported cash holdings of over $133 million. But the really crazy number, the one that tells the story, is the current ratio.
I saw that figure. 51.4. I mean, for anyone listening who isn't buried in balance sheets all day, put that in perspective. What does a 51.4 current ratio actually mean?
It means they have $51.40 in liquid assets for every single dollar of short-term liabilities. Most tech companies would be thrilled with a ratio of 2.0.
So 51 it's a war chest.
It's an absolute fortress. It means they're de-risked from any short-term cash crunch, and they have the freedom to make these big M&A moves without panicking.
And they've been putting that cash to work. Beyond the acquisitions, they closed a big financing round in Q3 for $48.5 million, and then raised another $72.1 million through an at-the-market offering.
And that successful ATM offering is key. It signals they could sell stock directly into the market without crashing the price. It shows you the investor appetite is really strong for what they're doing.
And we're finally starting to see this strategy hit the income statement, not just the balance sheet.
Exactly. Q3 2025 was their first ever profitable quarter. They reported $1.6 million in net income.
Now, we should flag that part of that was from unrealized investment gains.
We should, absolutely. But the core metrics look good too. Gross margins hit a record 39% in Q3. That tells you they're scaling effectively and getting more efficient.
Okay, but even with that profitable quarter, their trailing 12-month revenue is still around $8.3 million. That means the market is valuing this company on the future, on the story, not on where it is today.
That's precisely right. And that brings us to the engine that's supposed to drive that future story. U.S. defense and government customers.
This is the pivot, moving from a hobbyist brand to a mission-critical supplier.
Yes, and this whole strategy hinges on one thing: compliance. Specifically, the National Defense Authorization Act, the NDAA.
How much of a competitive moat does that actually create?
It's everything. It's not just a moat, it's the only way you're allowed into the castle. The NDAA restricts government agencies from buying drones or components from certain countries. It forces them to use secure domestic partners.
And the Department of Defense's Blue UAS framework is basically the approved list, the gatekeeper.
You've got it. Think of Blue UAS as the DoD's trusted list of components and systems. If you're not on it, you can't sell to them. Unusual Machines has 4 products on that framework now.
And that creates incredibly high switching costs, because getting that certification is a long, expensive process.
It's a huge barrier to entry, and we're seeing it translate directly into big wins.
Let's run through them, because the contracts are the ultimate validation here.
Okay, so they landed a contract with the U.S. Army 101st Airborne Division.
Wow.
Yeah, for 3,500 NDAA-compliant motors and other Blue UAS components, and then an $800,000 order from Red Cat Holdings, and another $3.75 million order from Performance DroneWorks. These aren't just sales. These are major defense integrators designing Unusual Machines into their platforms.
So to handle that kind of demand, they must have had to scale up their physical footprint like crazy.
Oh, absolutely. That's why they opened the new 17,000 square foot motor manufacturing facility, and then also leased a 25,000 square foot warehouse, both in Orlando.
Why Orlando specifically?
Well, a couple reasons. One, it's a major defense and aerospace hub, but more importantly, it's about onshoring the supply chain. To keep that Blue UAS advantage, you have to build this stuff in the U.S. It reinforces that whole compliance moat we were talking about.
Okay, let's switch gears to the stock itself. How has the market reacted to all this? What do the technicals look like?
The market has definitely woken up. The stock is up over 450% in the last year.
A huge move.
A massive move. And technically, the signals are pretty bullish. It's consistently trading above its 50-day and 200-day moving averages, which confirms a really strong uptrend.
For someone watching the charts, what are the key levels to keep an eye on?
Support seems to be holding pretty firmly in that $12 to $13 region. On the upside, the resistance has been in the $16 to $20 range. A clean break above that could really open things up.
And where do the analysts see it going? What are their targets?
The consensus has been raised pretty significantly. Most 12-month targets are now ranging from around $19.33 up to $20.74 per share.
So they see more upside from here.
They do. And what's really interesting is, despite that 450% run-up, the momentum indicators aren't flashing red. The Relative Strength Index, the RSI, is only sitting around 38.5.
That is strange. Usually after a move that big, you'd expect it to be screaming overbought.
Exactly. An RSI of 38.5 suggests it's not overbought at all. It actually suggests there's still plenty of room for more upward movement before the stock gets exhausted. And we're seeing the proof of that in the institutional filings.
Right, big firms like Susquehanna and Tudor have been increasing their stakes. The big money is moving in.
That's a huge tailwind. Okay, so looking ahead, the next few months are packed. We've got the annual general meeting in December and Q4 earnings early next year.
What else should people be watching for? What are the big catalysts?
Well, that Q4 earnings release will be huge. It should show the real impact of those big purchase orders. There's also talk of another major PO announcement around mid-January. And of course, we need to see them officially close that Aloft Technologies merger. That's critical.
And what about the more speculative chatter, the rumors?
Yeah, there's some interesting stuff floating around. A lot of talk about a potential move from the NYSE American up to the Nasdaq Q.
Which would bring in more institutional investors, more coverage.
For sure. There are also rumors about international defense contracts, especially with European agencies who are also trying to secure their supply chains.
And then there was that very public capital move they made recently.
The strategic investment into XTI Aerospace, they deployed $25 million of their own cash into it. That signals two things. One, they're confident in their own cash flow, and two, they might be building out a sort of venture capital arm to invest in the broader aerospace ecosystem.
Okay, so with all this excitement, all this growth, we have to talk about the risks, because a 450% run-up comes with massive expectations.
And this is the most important part for anyone looking at this. The number one risk is scalability and execution. Yes, they had one profitable quarter, but they have a long history of net losses. The trailing 12-month net loss was almost $36 million.
And that valuation we mentioned, it's steep.
It's incredibly steep. A price-to-sales multiple around 59x. That means you are not buying current performance. You are buying a promise of enormous future growth, any stumble, any delay could cause a really sharp correction in the stock price.
The expectations are priced for perfection, and what about that dual integration?
That's the other huge execution risk. Trying to integrate a hardware engineering firm and a software IP company at the same time is, well, it's incredibly complex. Getting those cultures to mesh, realizing the synergies they promised, if they fail to execute on that, the whole platform narrative starts to fall apart.
So to wrap it all up, we have this company that went from a hobbyist brand to a component seller and is now trying this massive pivot into a vertically integrated defense platform, all backed by this incredible balance sheet. What's the final takeaway?
The story is really compelling. And while there's definitely volatility and major execution risk, the combination of that fortress balance sheet, their unique NDAA-compliant defense position, and the aggressive integration strategy, it sets them up for a potential multi-year growth runway. They've built a real moat, and they're daring everyone else to try and cross it.
That transition from a simple gadget to mission-critical hardware. That's really the whole story here. So the question you should be asking yourself is, does that massive cash hoard give them enough runway to actually execute this complex strategy and land those big international contracts? Definitely something to think about. If you want more analysis and insights into companies like this, make sure you hit that subscribe button.